Of course, this is not financial advice and for entertainment purposes only. This one ETF has a 14% monthly dividend yield, no NAV erosion, and even growth, and that's TappAlpha's TSPY. Investors, yes, there's this one ETF by TappAlpha called TSPY. Now, this ETF literally invests in the S&P 500 directly through the SPY ETF, and it uses what's called 0 DTE options positions to allow this ETF to have a 14% yield that pays out monthly. This fund also pays out super consistent, super reliable, and super stable monthly income. It even has index options for tax efficient benefits for investors. It literally has growth, and even it's beating other zero dated funds and even other S&P 500 cover call ETFs, so it's super underrated in the best of all worlds. Don't believe me? Well, that's okay, because in this video, we're going to provide you a full and complete breakdown and even an update on TSPY with the CEO and founder of TappAlpha, Mr. Saikatara. And of course, everybody, this video was pre-released, so if you have our ETF Academy membership, you already saw this video, so kudos to you. But also with our ETF Academy YouTube memberships, you get a full and complete guide on 0 DTE options ETFs and even a guide on so many other ETFs. You even get price targets. You even get my own portfolio whenever I buy my ETFs, my own trades, and even so much more things like price targets. I just said that. You get to even ask questions to your favorite ETF issuers. It's literally a great bundle, a great value, all in our ETF Academy. So if you want to join, go ahead and click our link in the description of this video and even the pinned comment section to have so many other more benefits of our ETF Academy. Now, if you will, please welcome Mr. Saikatara from TappAlpha, where this ETF just achieved over $40 million in assets under management. It's been on a tear, and TSPY is actually one of the best performing, if not the best performing, 0 DTE and even just a regular S&P 500 high dividend cover call ETF right now in the last year. So first of all, Sai, how are you feeling being back on the channel, and how are you feeling about TSPY performing right now?
Marcos, it is great to be back with you. Love the work you're doing out there, and it's exciting to see the viewership go up. I am feeling so optimistic right now, and it's been such an interesting year with how volatility has spiked, what we went through in April, and sort of the comeback and the recovery. The best lessons in life come from some of the challenging times, and that's what 2025, the first half of the year, kind of provided. And I think that sort of speaks to how we've been able to sort of track the recovery the way we have. So appreciate you having me back on.
So let's kind of take a step back. We saw in April, the S&P 500 on April 9th went up 9.5% in one day. The VIX had one of the biggest spikes since '08, to my knowledge. And with TSPY being a 0 DTE strategy, that high volatility and that high movement isn't really the most favorable for 0 DTE strategies. However, you guys are managed to just outperform almost every S&P 500 and 0 DTE fund right now, just blowing them out of the water. You got to see some B-roll right now. TSPY just bouncing from that April 9th low and just walking along every other fund and even outperforming the S&P 500, which is just crazy to think about for a cover call ETF that I guess caps upside. But TSPY is defying all the odds and doing great things for investors. So can you explain to me how TSPY has been outperforming all the other funds and how TSPY is actually capturing the growth of the S&P 500 while providing 14%, around 14.5% yield every single month to investors?
Yeah, it's April 9th. That was such a kind way of putting it. Not most favorable. April 9th is basically D-Day for 0 DTE funds. That was literally one of the worst case scenarios that could occur. Market spiked 9.5% in a couple of hours. And so what do you do as a 0 dated fund? Because that's the whole strategy where you're writing a covered call where you potentially sacrifice some upside. But if you write it high enough, you don't necessarily sacrifice it. So that day, we ended up writing our call 5.25% out of the money. And we were like, this is like the most headroom we've ever had. There's no way the market's going to outpace that. And sure enough, the tweet went out from the administration and the market spiked. And, so we ended up capturing about 60% of the upside. But the real issue is, okay, What do you do then? We left 3.8% on the table that day. I think we were one of the best performing zero-day funds, but that's not ideal at all. So since then, we actually took some very deliberate steps forward to make sure that we can actually perform better in those environments. And so we did three big things. First thing we did immediately was we ended up actually modifying our prospectus. So we added what I call catastrophic insurance to the upside and the downside. So the upside, we ended up allowing ourselves in the prospectus to do what's called a credit spread. So we take our position and then we buy a further out of the money long call, and that basically insures against the April 9th. We also provided the ability to do what's called a protective put. So we can buy a put on the downside, which is catastrophic insurance to the downside. And we only have, we have rules to put this in place that are based on volatility. So when the VIX and certain other signals sort of hit our triggers, then we actually use those hedges in addition to our core strategy. And so that's one of the things that we did really quickly out of the gate that said, oh, okay, if this environment kind of happens again, we have at least some tools to use in our tool belt to defend against that. Second thing we did, speed is really important. So we had, it usually took about 10 to 20 seconds to go through our full process to take a position. That's fast for an ETF, but it's not fast enough when markets are moving that fast. So we ended up actually beefing up our underlying fintech and tied it right in to do automated trading with the financial information exchange, which is essentially like an institutional grade order mechanism. And so now orders actually execute in milliseconds instead of seconds. And so what that's actually done for us, we're able to get these limit order fills much more efficiently than we were before. And so we're getting about 10 to 15% improvement in our fill premiums. And that directly goes to help the relative returns of the fund. And then the third thing we did, you look at the market and there's kind of cursory metrics that you can track that kind of show you where things are. But there's something under the surface that shows you like the full topography of like where people's open positions are and the movement around that. We had informal ability to sort of see that picture, but now we actually formalize it in our fintech. And so the analogy I use, it's kind of like a fish finder. It helps you see under the surface of the market. And that's been a game changer for us with respect to where to put our strikes and then how to actually manage the risk throughout the day. So those are the three big things that we ended up, improving in the fund to make it stronger. And it's had a really big impact to the performance of the fund. And we've actually been able to get, we gave up 3.8% that day. Before that day, we had 2% of buffer. So we were about 1.8% behind the market net. And then we've been able to recover that over the ensuing period of time to sort of get back to par with the underlying security. So those are the things that we wanted to make sure we went through this time. Let's take that as a lesson and make sure we're using that lesson to strengthen the capabilities of the fund to continue to deliver the outcomes that we want for our investors.
One thing about TSPY is that it's income for today and growth for tomorrow. So what you're saying about going more out of the money and doing those protective puts, quote unquote insurance, is that for investors that I guess are heavily invested in these products that have a lot of money behind it? I know I'll put it on your screen. Maybe I'm not going to say a name, but this investor invested over like $400,000 into TSPY since our first interview. And so many others are hopping on TSPY because of the active management you guys are doing, the fintech behind it, the tax efficiency, even we'll touch on that as well, high yield, and even just the growth to keep up and even, I guess, outperform in this case of the S&P 500. You guys in the last year will say TSPY beating VU, beating SPYI, beating XDTE, beating JEPQ, which is fine because that's a NASDAQ 100 cover call, that's fine, and even JEPI. So how do you feel about that? Those are big names on the street. I'm not going to say you guys are quote unquote little dogs, but you guys are innovating, defying odds. Just it's incredible. I'm just blown away about the performance and how TSPY is even innovating ETFs and even with this strategy of a zero DTE cover call on the S&P 500.
I think, the names that you listed, like they're fantastic funds. And a lot of them even have different underlying strategies too. And I think this is sort of the next iteration of what coverage call strategies are becoming. And then, the idea, so like we're using zero dated, but even how you implement that particular strategy to do out of the money covered calls matters. And I think that's the biggest thing. I love being a part of this industry because a lot of these folks have sort of done the lead blocking to sort of get the industry where it is, to get the interest in the market. And then we're coming in with a bit of a different lens from the technology side, adding the finance expertise, and then trying to push the industry forward. And I think, TSPY has always been the example or model of what we know and we believe the fintech and the underlying strategy can deliver. As we're coming up to our 1 year anniversary, the coolest part about all of this is all of the improvements that we built into the fintech platform will also be beneficial to our future products as well. But this was the test case. And so coming up on a year, seeing the growth, seeing the market interest, and a lot of it, so much of it has been the retail investor. And the thing I love about it is retail investors are smart. They're getting educated. They're understanding, wait, I see a high yield number, but that doesn't necessarily mean that total returns are there. It may not be a fit for what I need as an investor. This movement is such a powerful thing. And we're the little guy. Like we came in, we're at 42 million in AUM, but it's a first time fund, first time issuer. We didn't have institutional seed. We didn't come in with 50 million like a lot of these organizations that have 10 other funds can actually reallocate and start at a level that opens doors. We're truly like the underdog that we're trying to democratize and give access to powerful strategies, but we also don't have access to the institutional platforms that a lot of the other guys do. And so retail support for us is unbelievably important to help us get here. And we're so appreciative and we're so impressed with how the investors on your channel, the viewers that you have, understand these concepts and can make choices for themselves and their families. So we're super grateful and excited to sort of be where we're at.
With April's distribution, I think it was like 27 cents. TSPY has been pretty consistent with the income. We saw like a couple cent drop off in April. Was that because of the growth that was captured from TSPY rather than, I guess, going more in the money to capture more income?
Yeah, it was actually so April because the volatility was high, and then the market in the beginning of April went down, April 2nd. The distributions component was actually more options premium because volatility was high. So we were able to fill some of the gap with the pure option premium because there was just more available. The VIX in April was above 30 for 2 weeks. Like that doesn't happen very often. So that's what's really cool about providing an income component to the product where we're dead focused on growth and we want to provide this consistent income because we understand investors are like, they're planning their lives on hoping for that consistency in income. And so when the markets are doing this, we're trying to find ways to make sure we can put some shock absorbers in to give you that steady stream of income.
So we've seen that TSPY performs well in a bull market, in a very rising market. So with those protective puts, will TSPY perform, I guess, better against other zero DTE funds and even other regular S&P 500 cover call strategies?
Potentially. And so it really depends on execution, where we have rules that say when the VIX is elevated and there's maybe a negative bias in the market, that's a signal to us that maybe we need to buy a little downside insurance. The trade-off, of course, is you pay for that. And so you get a little bit less premiums. And that's the trade-off that we have to decide when to use it. But if we put it in and we have the power to put it in either as a daily put or more likely a longer dated put, because the premiums are actually more attractive from the buy side, that safety net, depending on the bias, could provide at least a peace of mind where if things do take a turn south, that we'll have a capability that some of the other funds don't have. And that was the idea. We want to try and do everything in our power to protect the capital and make sure we're delivering on what the fund says it's here to do.
Benefit of using a zero DTE cover call strategy versus the traditional 30-day option strategy. TSPY has just been performing super well. So I'm just super curious because some investors might not be informed about what zero DTEs are, and some ETF issuers might not specialize in zero DTEs like TappAlpha, but they're trying to get their foot in the door with this zero DTE strategy.
The zero DTEs, they've only been around since the end of 2022, and there's three big reasons why we implemented TSPY with zero DTE. First one is, if you write if you use a traditional 30-day covered call strategy and you take, one measure of risk is delta. So if you sold a 25 delta call over 30 days, you get X dollars in premium. Versus if you actually do the same risk, so 25 delta, but you just sell it every day over the same period and collect those premiums and add them up, the premium opportunity is 4 to 4.5x that of a traditional 30-day strategy. And I was like, why is that? And there's two reasons. One, options, they decay very quickly right before expiration. So you're taking advantage of that slope every day versus a 30-day, you're kind of slow playing it until the end. And then the second piece is 0-day covered calls now amount for more than 60% of the options volume on the S&P 500. So there's tons of liquidity and tons of demand. And so that market is there and it really helps support that, a bonus premium for the same level of risk. Second thing, this is a big one. We do true zero DTE, meaning like we're on only 6.5 hours a day. So we skip all the aftermarket risks. So when earnings announcements happen, when macro announcements happen about this morning was CPI and inflation, I didn't have to worry if there was going to be a spike because I was risk off with the option. And so we're able to be way more surgical, and that's so helpful for risk management in the process. And then the third thing is you just get more at bats. If you're doing a 30-day, you get one swing to sort of get it right over the month and things can change. Versus zero dated, you're actually able to take 22 swings every trading day. And so the analogy I use is like if I'm flying from LA to New York and I'm doing a 30-day strategy where I only get one swing, I have to point my airplane right at JFK's runway. And it may be right at the beginning, but guess what? If there's a gust of wind or a thunderstorm that comes over that flight time, you don't get a chance to readjust to that. But if you're doing a zero-dated strategy, you can actually adjust to that 22 times along the way. And so there's just a much higher probability you're going to get where you're planning to go. So those are the three reasons why we built TSPY with zero-dated. And that was the goal. Like we wanted to be able to deliver as close to or potentially outperform the underlying index from the growth perspective and add this income engine on top. And that's, kind of what TSPY has been able to deliver because of the power of the underlying tools and how we've been able to implement it.
TSPY having an over 14% yield and even growth and outperformance against competitors and even the S&P. Usually, if you have a higher yield, you might be sacrificing on the growth side, but TSPY has the high yield and the growth and the outperformance. Kind of hard for me to wrap my head around of like, is it because of the zero DTE strategy and the fact that you guys don't use synthetics and you guys own real shares of the SPY ETF, which is a direct, I guess, one-for-one movement of the S&P 500?
That's a piece of it too, because we're balanced growth and income. So you raised a really good point. The implementation matters a great deal for how to actually deliver a balanced growth and income product. So one of the things when we're building TSPY, our custodians and the banks originally were like, it's really hard to implement owning physical shares in an ETF for lots of reasons, collateralization and all this stuff. So they're like, can you just do a poor man's covered call and do a synthetic, and then it's just options on options, and then it's a piece of cake for us to implement? I'm like, no, no, I don't want to do that. Like, how can I explain that to my mom? I was a SPY holder. I'm like, I just want to trade my SPY shares and then own virtually the same number of SPY shares wrapped in TSPY and do this little engine. And I'm so glad we fought for it. It took us an extra 6 months to get it launched. We would have launched 6 months earlier if we didn't push for that. But I'm so glad we did. And there's two reasons. One is the growth side of the growth plus income. So if I had a synthetic implementation, come year end, the capital growth that's synthesized in that underlying option, I can't keep it in the ETF. I have to take that growth and distribute it out. So a lot of those synthetic funds, you'll see a big distribution in December. That's because of mark-to-market rules for the options contracts, and ETFs just aren't allowed to keep income within the fund unless they pay capital gains on it, all that stuff. So virtually they have to distribute it. But if you own physical shares, the value of the SPY shares, like we're not trying to sell those SPY shares. So we have a value store that after New Year's Eve can go into the next calendar year and continue to grow and compound within the shares of the SPY. That's really powerful when you're talking about trying to get NAV growth, and there's a really big potential tax benefit to it as well. You don't have to take those big distributions if you didn't want to, and you can be a growth investor and continue to see that growth compound within the fund. And those things were non-negotiable for us, and you're starting to see that come to fruition.
NAV erosion and NAV decline is a big topic for high income ETFs, but not with TSPY. My question is, how does TSPY have no NAV erosion? Because a lot of investors, when they look at a high income ETF, the first thing they look at is the NAV without income. And when you're factoring total returns, TSPY is of course performing super well. So the question is, why no NAV erosion, and why maybe your take on NAV erosion for these high income funds, if you want to touch on that.
Yeah, I think, different funds have different goals and different investors have that too. So for us, we try to be super transparent and very clear about what the goal is of TSPY. It's growth plus income potential. Other funds are just pure income. But if you're growth plus income potential, one of the big contributors is how we built the fund and actually owning physical shares. That was big in order to make sure that we can have a nest egg that hopefully continues to grow, but it kicks off consistent income. That's the goal of TSPY. Other funds may have different goals where they're super high distribution. I won't even call it yield. It's super high distribution. One of the easiest pieces of math to do is if your total returns, which is a really critical number to understand, is less than your distribution number, what does that mean? Where does that money come from? So let's say I'm distributing 50%, but the total return of my fund is 20%. Where does that extra 30% come from? It's just math. Well, it has to come from your original capital base. And so over time, if that keeps up, your original nest egg will start to shrink because you're distributing all of that income out. And unless you're reinvesting in, that's one of the key things to understand. So it's so confusing the way finance is, and it's so confusing with all the numbers: distribution, yield, this percentage, total returns, market price. But just understanding the core basics, not because one is better than the other, but just to understand what's better for you is so important. And that's a really simple formula that people can do. Total returns minus distribution. If it's positive, then you probably don't have NAV erosion. And if it's negative, you might. And then the last piece is NAV erosion itself can also be a function of how the fund is built. So if it's using synthetics, this is the hard part about it. This is why we avoided it when we were implementing TSPY. If you have a synthetic, you cannot do better than 0% for NAV erosion at the end of the year. You're going to be 0% or negative because you have to distribute out all of the potential gains that you have, even in your underlying synthetic. So those are two things for us that were non-starters for what we wanted to deliver with growth and income. But it's totally appropriate if you're just looking at pure income funds, for example.
The income has been super consistent month from month. And some other cover call funds, you might see a huge spike in income and then a decrease, kind of flat, decrease again, huge spike. But TSPY has been super flat, which is great. Consistent income. Some people like to budget around that distribution, like to have a stable, predictable, reliable income stream from TSPY, for example. So was that the goal for the distribution, is to make it consistent and reliable for investors?
That's exactly the goal. We can't promise it because markets are unpredictable, but really we work so hard to try and make sure that we can give consistent distributions to meet expectations for exactly the reason you mentioned. We get a lot of inbounds from people that are saying, this is a long-term buy and hold thing in my life. And the fact that it actually helps distribute a consistent amount every month helps me plan my life. And over time, I believe the S&P 500 will help provide accretive, additional returns. But that consistency is so important for me and for my family. And that's exactly what we're trying to deliver. Can't promise it, but we work really hard to make sure we can.
Can you also touch on the tax benefits, or I guess the tax implications of TSPY? Because you guys use index options, correct? And that's something that people don't know about TSPY, is the benefits of index options because some other products use equity linked notes or ELNs,
Right.
or maybe all of their distributions are just ordinary income. Maybe some of them are like 97% return of capital. So can you touch on the tax implications and the tax, I guess, benefits of TSPY with index options?
One of the things that I learned the hard way when I did this strategy before we started TSPY, and there was nothing out there on the market that I could invest in, so I just did it myself. Everything, the options gains, and then even the capital growth of my underlying SPY shares, if I had to sell a few in order to like make my monthly bills or whatever, all of it was ordinary income. And that was crushing for us. But when we put it in an ETF, there were two big benefits. One, the options, like we use SPX options, but guess how much one SPX option is that you need to have for corresponding shares to make it a covered call? You need $500,000. So from an access perspective, it's very unlikely that a lot of retail folks have that to even trade one share of SPX. And the tax benefit of being able to do so is you get potentially 60% long-term capital gain treatment of the options premium, 40% short-term. That's a huge benefit. And so ETFs, this is why I love them, is they democratize and make accessible stuff that sometimes only institutional or wealthy have access to, but now everyone can have access. And then the second thing was, this was the big one that I got deep in the tax code on this. One of the things when you do a covered call, the underlying shares that you own end up actually pausing the capital gain clock on the underlying shares. So if I buy SPY and I'm doing this every day, even if I hold it for more than a year and I sell that SPY to get the gains and liquidate that, the gains are going to be taxed at ordinary income potentially. So I'm not a tax advisor, so talk to your own accountants. But when you do it inside the structure of an ETF, ETFs actually never liquidate. So like we try not to liquidate the SPY shares. So if somebody sells a share of TSPY, say 18 months later, those shares go back to the bank in kind. And that short-term categorization goes away, and all the investor has to pay potentially is long-term deferred capital gains on the underlying NAV growth. That is a huge difference from what I was doing when I was doing it natively in my investment account. So the ETF structure and then the implementation using physical shares really has some big benefits when it comes to the tax side of the equation.
Can you explain how sometimes TSPY can outperform an S&P 500 ETF like SPY, VOO, SPLG? The narrative is a cover call, caps upside, and it can't outperform the underlying asset. So in this case, the S&P 500, but in the last week and on the year, TSPY is doing just that. So can you touch on how sometimes TSPY can outperform the S&P 500?
The big driver of that is the zero dated option tool. And it's for those reasons that we kind of walked through before, but there's a much higher probability because you can get really granular with how you actually set your strikes every day to get to a point where you are able to take the net option premiums and make it truly accretive on top of the underlying S&P 500 growth, depending on what the market does. And the biggest knock on covered calls is in a bull rally, traditional strategies just you can't keep up with the underlying because you just keep getting capped out month over month. But with 0 days, you can set your strike, and then if you touch the ceiling, guess what? You can raise your strike the next day. And that mechanism is what helps you potentially capture a little bit more than the underlying. And since we're growth plus income, like that's our goal. We want to capture as much, if not all, of the underlying security, and then we want to add this value on top over time. Zero dated options give you the best chance to do that.
Regular cover call ETFs on the S&P are about 8% to 12% yield depending on the market. TSPY is more than that at 14%. When you saw that gap of, hey, we got the potential to pay out more income while having growth, was that a part of the market where you guys saw opportunity and create TSPY?
Yeah, so this was an interesting struggle at the beginning because, we saw like the long time horizon was important. Like to me, I'm obviously a big investor in TSPY. Like I took everything that I was doing in my individual account and I'm a shareholder of TSPY. And so like that balance was important, But then the retail market likes higher yield. And so we were just trying to find the balance. Like we had one swing to get one product right. And we may, in the future have an opportunity to change that. But with that one swing, what do we do? And so the first yield number that we put out there, like kind of got poo-pooed from the retail community, like, oh, that's not exciting. And then other products were way too high. And so that's what actually landed us right in the middle at 14%, which seems like the right balance. And it scratches the itch for the investor group that is concerned with both growth plus income. And the best part, some people even don't even use all 14%. But because we're, potentially able to distribute tax efficiently, you're able to reinvest the distributions without much tax drag, if any tax drag at all. And so that's what gave us the flexibility to say, okay, we'll distribute 14, but if you're only using 8, you don't lose anything by using this higher distribution. And that was the balance that we came to because we had one swing to get the product right.
Investors love high yields, but some of them love weekly income. So will TSPY ever go weekly? Or maybe you guys ever release a weekly income product down the line?
See, you asked the back part of that question. I think there is a potential in the future, not too long out, to create a higher yielding weekly product that uses the same TSPY core, but it ends up distributing a higher potential yield and doing so on a more frequent basis. I know retail really supports that idea. And, one of the main differences is like TSPY does what it does really well, but how do we take that and package it in different ways to support different communities? And I think that's definitely something on the horizon that we'll talk more about once we get past our initial AUM goals for our current fund, which we're getting close to, which I'm excited about.
One question I got asked was how much of the cover call strategy is automated versus human decisions? I know TSPY is that fintech power that I guess has a competitive advantage versus other ETF products. So, how much of the options decisions is human versus automated?
I'd explain it as it's a co-pilot. So there's not a single trade that goes on without me making the final call. But all of the data and information that is mind spinning gets pulled in real time and processed in a way that the portfolio manager can understand it very clearly to understand risk reward. So every call is definitely has the human touch, but all the hard work, grunt work, processing to make it easy to understand is done with the automation. And it's that combo that we found a really great balance for. And we even have AI that's built in as like a virtual portfolio manager as a co-pilot that kind of gives an opinion based on some of that data. And we're kind of tuning that to make it like a virtual me over time, but there are no plans to be fully automated at all. It's really important to have the human touch, especially at this point in the growth phase of the company, because we want to make sure we're doing right for the goals of the fund and for the investors.
What's one thing that investors are getting wrong about TSPY? Potentially.
It's a good question. I think one thing is the AUM level. We're at 42 million after 11 months, and it's really relative. So some people are like, well, why are you only at 42 million? But then others that are like, wait a minute, you're a first time issuer, you don't have any institutional funds, and you don't have any seed funding, and you're at 42 million already in 11 months. And that's, I think, the biggest challenge is helping people understand, like, yeah, it's hard. It is hard to break into the ETF industry as a first time issuer. But the only reason we've been as successful as we have been to get to the level is because of the retail crowd understanding what's under the hood and being motivated to try and innovate and participate in that. And I think the other thing too is like our why is different from the perspective of like the purpose of the company. And TSPY is just one instantiation of that. But the whole name of the game for us is access. We want to provide access to powerful financial tools for everyday investors and advisors. It's very different, I think, coming into this industry with a technology background or different experiences, but really focusing on our core investor and delivering value for them. But I think that's the biggest sort of misconception is AUM level and sort of understanding what does that mean? Is it good or is it bad? I'm really proud of where we are, and I'm really thankful and grateful for the retail community for helping support us to get the fund to where it is so that we can do more and offer more products out there for investors that are part of our community.
Some high income cover call ETFs with high yields, they have them at like a lower position just because of, I guess, risk or growth potential that they might be sacrificing with these higher income products. But with TSPY, I've been noticing that these investors are having TSPY as a core position because of the fact that TSPY combines the power of the S&P 500 with the potential for growth and of course income, because investors don't want to wait, I don't know, decades to sell off shares. They want the income if they want to spend it or use it or even reinvest it back into the fund. So the question is, how do you feel about investors using TSPY as that core position in their portfolio?
That makes me so happy, because that's how we designed it. And that's the big question, and we have conversations actually with advisors too, through their lens and retail investors. And they're like, wait a minute, I can take the SPY shares that I already have and transfer those for TSPY shares, have the same S&P 500 exposure, but now I'm adding this income engine on top. That for me scratches two itches, but the risk profile, looking at your performance over the last year, is very similar to the S&P 500 exposure I had with SPY. And so for that, you just get the bad analogy we have now is like, you've got the traditional vanilla cone, but now you've got the traditional vanilla cone, which is your S&P exposure with sprinkles. And those sprinkles are the options income that's done daily to help you achieve your income goals. And that's exactly what it was designed for. So I'm so happy that people are actually using it in their portfolios that way.
Any new ETFs on the horizon? Any new ideas you guys have on the table for investors?
The immediate one on the horizon, and we get so many inbound requests from the retail community, which makes me so happy too, is TDAC. So one of the commitments we made was when TSPY crosses 50 million in AUM, that's when we'll get TDAC queued up to launch as well. So it'll be the same strategy on the NASDAQ 100 using the same tools, just tuned for the Qs instead. That'll also have, it has, more potential income, but the same strategy ultimately. And then downstream, we're looking at a couple other product lines. I'll keep those quiet for now. But one of the things that's been whispered in our ear that there is demand for is light leverage. So keep that in mind, where for our risk profile, which is kind of low to moderate, there are some potential leverage solutions that could fit that. They're not crazy, but they add a little enhancement that people, I think, could get excited about.
One piece of advice, of course, this is not financial advice, for investors who are trying to navigate this highly volatile market that want to harness the volatility with an ETF like TSPY, or even just your take on how investors should navigate this highly volatile market we're experiencing right now.
Options are really interesting because they're a tool that goes out and converts volatility into income. And people are like, well, I've got this bond strategy for income. It's a different thing. Those are interest rates, and that's driven by a different market. Volatility is what we're seeing now. So this is a great time to look at options-based strategies to harness that volatility to turn it into income. I think if ETFs are the tool that people use, it's really important to get educated on what's under the hood. How is the fund built? What are the total returns? What's the distribution? And what's the character of the distributions that come out? Is it truly return of capital that's destructive? Is it ordinary income? What's the tax implication going to be? Just answer a series of 5 or 6 questions, do the research, and that will give you, and I'm not saying anything's right or wrong or good or bad. It just gives you the tools to understand what's a fit for you, your goals, your family, your needs, and without cracking the hood and just getting stuck on maybe one dimension versus getting the holistic picture is very dangerous to get a mismatch from what the fund would do versus what your needs are. So that is my one piece of fingers crossed advice that people take. Just crack the hood, do a little bit of research. It doesn't take long, but that will give you so much peace of mind to know that you're investing in the right thing for what your needs are.
You guys heard it first here from the CEO and founder of TappAlpha, Mr. Saikatara. Now, if you guys like this video, please give it a like because this cute puppy did. And go ahead and check out our last conversation to give a full and complete breakdown of TSPY right here. I love you guys so much. Crush the stock market and take it easy. Peace.